This was done for effect, and it was done either to cover shorts, to take possession of physical, or to rattle the bushes and make people think all of the things that the mainstream said, a lot of which were valid. Gone up 9 straight weeks in a row, was overbought, in need of some sort of a flush. Okay, I believe all of that. And if it had been done properly, the right way, over time, instead of all at once, when the market was liquid instead of when it was illiquid, well, maybe I'd believe that. But it was done for effect. And so I would suspect after I research tonight or tomorrow morning what happened today, we'll see similar footprints in the snow that will talk about, this exact same thing. It's an emotional thing to see price fall the way that it did, but it is really done in a very irrational way that isn't being reported, and they're dumping it in a matter specifically to affect that type of sentiment and that type of aggravation.
At 3 a.m., when the world's trading infrastructure is asleep and liquidity is virtually zero, something bold and unsettling happened. Silver was crushed deliberately. This wasn't your typical market correction. It was engineered for maximum psychological impact. Andy Schectman calls it what it is, a strategic dump, timed precisely when very few participants are active, designed to rattle weak hands and reset sentiment. And yet, while the paper price took a beating, the physical side of the market is telling a very different story. Huge deliveries, record standing for delivery numbers, and big institutions quietly buying metal. The obvious question, who's behind this? And why now? Because the answer may reshape your entire investment view.
Well, you can see the reaction by doing it the other way, dumping it, the reaction that it has. It's, oh my gosh. And to your point of fiscal irresponsibility, the U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York, or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where at the same time you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And again, Think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being a problem, I think, are missing the picture. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery an immediate contract in October.
Let's dig deeper. First, the landscape. The U.S. has added over $1 trillion in debt in just 71 days, an unprecedented scale of fiscal expansion that's now driving interest cost to become the largest federal budget item. Meanwhile, debt to GDP is racing toward approximately 130%, a level from which no dollar reserve currency nation has ever fully reversed its decline. This macro backdrop is critical because it's the foundation of Schectman's thesis. Next, the metals market itself. According to Schectman, what we're witnessing is a massive disconnect between paper and metal. On the paper side, futures, ETFs, short positions, the price of silver is being aggressively suppressed. On the physical side, actual metal deliveries via the COMEX and allocated stacks, demand is surging. October deliveries of silver alone are approaching 39 million ounces, placing it among the largest months ever. And the ETF short position for the Silver Trust, SLV, stands at over 80 million shares, representing approximately 15% of outstanding shares. This suggests not just paper manipulation, but real accumulation of metal behind the scenes. Then there's the global shift. China's payment rails and settlement rooms are increasingly rejecting the US dollar monopoly. The cross-border interbank payment system, CIPS, now counts 185-plus countries, and yuan balances on the Shanghai Exchange are convertible into gold, effectively creating a yuan-to-gold backdoor. As such, the reserve trade is evolving. Not just gold, but silver is being positioned as a hedge against the unraveling of trust in fiat. What does Schectman want silver and gold investors to grasp? Here are the core messages. Physical over paper. Don't trust the price action alone. Look at how much metal is changing hands and standing for delivery. That's where the real signal lies. Suppression doesn't mean absence of demand. Yes, the paper price may be beaten down, but it's being done for a reason, namely to allow large players to accumulate metal at discounted levels. Macro forces are converging in your favor: exploding debt, weakening fiscal credibility, de-dollarization, central banks buying. These are not background noise. They are the core context for precious metal investors. Time may not be on your side. If you wait for mainstream recognition, you may miss the stealth move into metal that happens before the crowd sees it. Schectman's view: we're in the early innings of a secular bull market in gold and silver, and possibly a sharp move up when the suppression breaks. Finally, remember his mantra: pay yourself first. Build your stack of metal consistently, no matter what the macro noise says. Because when the system resets, it's those who prepared quietly that win, not the ones chasing the last wave.
So what was interesting to me about it as well was some of the, I think it's Michael Lynch, I think is his name, I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Thursday and Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market. Period. No one would ever do that. They did. And it's done for effect. Specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night, or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity, to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1, and gold about halfway up. Because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets sell. I found it interesting. Both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett, and for the lead analyst for Bank of America, that has a big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25-25, 25-25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this, and all of a sudden they come in and buy over 600,000 ounces, where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. Well, yeah, and that's why you're seeing, as an example, China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using CIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan-to-gold backdoor, and the next vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro-yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, and nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in just 71 days, we at 100 billion a week. You know, how long can that go on? I think, people need to think about this. And maybe this is why you're seeing big money start to move into gold. The central banks have been front running it, and now you see Bank of America, Jefferies, Morgan Stanley, JP Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael or the big bond trader, the bond king for BlackRock, that Jeffrey Gundlach, say a 25% allocation to gold is not overweight. I mean, that's just unheard of to say that. Look, the deliveries off of COMEX, to me, really more than anything, are telling you that the most sophisticated traders in the West feel the same way. And if they're going to knock the paper price down, well, they'll cover their shorts and they'll stand for delivery. And we're seeing that.
So here's the takeaway. When you see silver smashed at 3 a.m. in illiquid markets, and yet physical deliveries soaring, short positions monstrous, global trade shifting away from the dollar, you should not view this as a failure of precious metals. You should view this as the quiet setup for a major move. Do you believe this dump was just a panic sell-off or an engineered shakeout before a bigger breakout? Drop your answer down below. I want to hear your take. Are you stacking physical metal? Do you believe silver is still undervalued? If this breakdown added value, hit like, share with someone who needs to see it, and subscribe for more deep dives into global finance, de-dollarization, and precious metal markets. Ring the bell so you don't miss the video, because the big move might be closer than you think. Until next time, stay sharp, stay stacked, and stay ahead of the wall of change.